what we're going to look at this evening is proof that whole life insurance works. Well, what we're specifically going to focus on are real policies that have lived the test of time, and we're going to examine the results. Now, the focus of these whole life insurance policies will be the cash value. That's what we're talking about, because that is what everyone is always interested in. Everyone we work with typically expresses that they are interested in the cash value. So a quick note before we get into what we'll cover. At the end of this evening's session, we are going to have a Q&A session. If you have any questions during the presentation, please leave them in the chat, and then we'll be sure to answer them at the end of the webinar. So what we're going to cover is as follows. First, we'll review actual whole life insurance policies. This is what we're going to spend the majority of this evening discussing. We're going to look at policies that are 5 years old, 10 years old, and then some that are even older than me. And we'll look at good policies, bad policies. We'll get to see a large variety here. Now, after we look at those actual policies, what we're going to cover next, or second, is how people are taken advantage of with whole life insurance policies. What we're going to do is reference the actual policies that we look at, see when it does not work versus when it does work, and that will lead us into step 3, which is how to copy what works. Specifically, if I'm interested in a whole life insurance policy for the cash value, what insurance company provides proof of performance, and then how do I set the policy up or design it where I make sure I reduce expenses, reduce commissions, and then increase my cash value as if I am the consumer, being you in this case. So, when it comes to whole life insurance, have you ever heard that it is a bad place to put your money? Maybe a family member says it is a ripoff. Stay away from that stuff. Maybe a financial expert says these policies produce 1 to 2%, a 1 to 2% return on your money at best. Do not put your money there. You are much better served putting your money elsewhere. Or maybe a trusted friend says, don't do it. I've gotten whole life insurance before and it has been a ripoff. In fact, here's my policy. Here's an example of a whole life insurance policy that is not attractive at all. There's a lot of columns here, but I'll point to 2 just to keep it simple. Here's what he pays, about $1,000 per month. Here's his first year cash value, 0. Next year, might as well be a 0. It's not very much. It takes a long time before he builds up any real value. This is not a good whole life insurance policy when it comes to getting a policy for cash value. So, have you ever heard that whole life insurance is a bad place to put your money, specifically for the cash value? Most likely, a lot of people have. What would change your mind? What if you heard any of the following? If you heard that a hedge fund officer puts $500,000 per year into whole life insurance, and he does this for the cash value, specifically because he's interested in growing his money safely. He sees that it produces between 4 to 5%, and then also the tax advantages, that being tax-free, is extremely appealing to him. Would that generate any interest? What if you heard about a real estate investor that has saved more than $2 million in whole life insurance policies, primarily for the cash value, because it's a safe place to grow his money between 4 to 5% per year. And then also he really likes the loan feature, being that he can access his money anytime. And when he accesses his money, it continues to compound as time passes. What if you heard banks put a ton of money here? What if a bank put $25 million in a policy and they did it for the cash value because the growth rate was between 4 to 5% without any risk, and they also like the tax advantages? If you heard those 3 things, would that generate interest in whole life insurance policy? Or when you first heard, stay away from it, okay, I don't want it, then I hear this, What are your thoughts now? Well, if it's me, if I heard it, I'd be curious. But I'm only going to believe it if I see it firsthand. People have a tendency to believe what they see, not just what they hear, which is the theme of this evening's webinar. I want the proof, baby. Show me that it's real. So instead of just telling you that it works, let's look at examples for these three individuals, or two individuals and one entity that we mentioned. Let's begin with the hedge fund officer. So what we're going to look at first are the original illustrations, and then we'll look at his combined policy values. So what we've got is as follows. He took out two policies, one with Guardian, one with Mass Mutual. We can see how much he's funding here. $300K per year with Guardian. There's his cash value. There's his death benefit. He got this for the cash value. And then here is his Mass Mutual policy, which this one he's actually in the process of getting right now. So here he's funding $200K per year, and there's his cash value through the fourth year. So what we're going to do is show you his balance sheet when it comes to his life insurance policies, and we'll start with this guy. All right, so what we've got here is his total payment. What do you see? $500,000 per year. What he's doing in his particular situation is moving excess funds that he has in cash, specifically a money market, into a whole life insurance policy. The reason why is because he likes the annual yield. He actually made a comment. He works for one of the largest hedge funds in the world. He's actually worked for Goldman Sachs, JP Morgan, super, super bright guy, one of the sharper guys I've ever connected with. But he made a comment about the long-term growth rate of whole life insurance products. He said, if you're able to get 4 to 5%, that's also tax-free, with no management or maintenance whatsoever, that's extremely attractive, especially when I compare it with fixed assets that are offered by hedge funds that he works for, or other large hedge funds like Citadel, for example. So that's why he was extremely attracted to it, and why he's putting such a large amount of money into his policies, I should say. So the annual yield represents the net growth rate on a yearly basis, net of all fees, expenses, everything with the policy. Worst year is the first year. That's always going to be the case with a whole life insurance product. But for him, he is in a high tax bracket. He's in the highest. So when he looks at the taxable equivalent, it's quite attractive. What that means is he would have to earn the yield you see over here under this taxable equivalent column. He would need to earn that, and then after paying taxes, he'd be left over with what he sees over here. So he says, if I'm going to earn this annual yield tax-free, or even close to that, without any management, yeah, sign me up. And he's doing other things with his money as well. But here are his two policies. Next, let's take a look at the real estate investor. So we're going to look at 4 policies that he's taken out over the years. So we took his first out in 2019, his second also in 2019. These were both with Guardian, one on him and then one on his wife. And then he took one with Mass Mutual in 2021 and another in 2022. So what's in blue is how much he's funding every year. To simplify this, we've got one large illustration here that just combines all of the values. So everything in that red box represents what has already happened. Everything after the red box is what he plans on still paying into his policies. And again, these represent the combined values. So his goal was to use this for what? Real estate. So he does look at fairly large deals. For example, he might look at a shopping center that'll cost between $1 and $1.5 million. So what we don't do for folks like this, here we've got the year 2025 over here. Here's his cash value at the end of this policy year, so almost $3 million. If he wants to pull out $1.5 million, he easily can. He can access up to about $2.8 million here. But let's take out a $1.5 million policy loan. And here's how we analyze loans. So when he takes this loan out, what he wants to see is the net cost to borrow. So here's the interest rate, 5.5%. That's the average of all 4 policies. I plugged in an average there. There's the loan balance at $1.5 million. Here's his yearly cash value growth. So with the whole life insurance policy, when you borrow against it, you continue to earn dividends and interest on your full cash value as if you never touched it in the first place. So there's no lost opportunity cost there. So when we go back to the column in purple, that's our yearly cash value growth. If we look at this year, 2025, he took out a policy loan. 1.5 at 5.5% is what in interest? $82,500 for the year. That's the interest payment. What did his money grow by this year? $82,000 and change. Just about a wash here. He's negative $328, which he doesn't really care about that much. Now, if he pays interest only, you'll notice the next year, cash value grows by $117,000. The interest is still $82,500. So he's paying the interest every year, which the interest is just on the $1.5 million, while the cash value continues to compound on the full balance we see over here. And if he pays it off, which he plans on doing, here's what it looks like. Let's just pay it off. $300K per year, can be any pattern. But once it's paid back, loan is 0. There's his cash value growth, continues to compound at the same pace, and there's the interest that continues to be paid down every year. The nice thing here is the spread shows you the net difference. So the last year, he earned $156, he paid $16,500, which means he was net positive about $140,000. And again, these are his actual policies that we just looked at here. The last example, the bank. So this is a bank that we work with that had the privilege to set their policies up over the years. Their first purchase was in 2020 with MassMutual and Guardian. It was a $10 million purchase. That's the dollar amount they deposited. So it wasn't a $10 million life insurance policy. They wired $10 million to MassMutual and Guardian. There's their cash value. There's the death benefit initially. In 2021, they liked it so much, they made another purchase. It was with MassMutual, Guardian, and New York Life. There you go. And then to the right, the 2025 purchase. Here we go, $5 million. Actually, here's the first year cash value up here. And there's the first year death benefit. And on the far right, we've got the combined values, which just shows everything, what it looks like as of 2025, $29 million in change. And the cash value just continues to appreciate as the years pass. But these represent policies, several policies, that an actual bank owns. And thus far, they've deposited $25 million. So seeing actual policies that have lived the test of time, would that help at all if you initially said, I'm not interested in cash value life insurance because I've only heard negative things? Here's the standalone bank-owned life insurance illustration on the actual insurance company ledger. Face amount is the death benefit. There's the net cash value. First year, they've got a positive return of more than 4.5%, along with the tax advantages. That's why they're attracted to it. So does that help at all? Maybe, but these are just 3 examples. So let's take a look at some actual policies. We're going to look at several, and we'll go through the policies one at a time. So what we're going to look at are policies that are 5 years old, 10 years old, and then some that are older than me. And here's what we'll focus on. So first, we've got bad policies. What does it mean to have a bad whole life insurance policy? Here's how I would classify it. You're interested in a whole life insurance policy. When you put money into your policy, you explicitly state, I'm putting money into this policy for the cash value. You are told or led to believe that the cash value is going to be maximized, meaning you're going to have as much as possible with the insurance company and product that you purchased. But after getting it, you find out that that is not the case. You see low cash value in the first year. Maybe it's 0 or it's a small percentage of what you paid in. It takes 7 to 10 years just to get your money back before you see a gain on the policy. And then you see very slow growth over time. We're going to look at policies that demonstrate this. And then we've got good policies. Well, what constitutes a good policy? I would say high cash value in the first year. Specifically, somewhere between 80 and 90% of what you paid into the policy is in the first year cash value. Next, it only takes 3 to 6 years to get your money back instead of 7 to 10 years. And then third, we see much faster growth. Now, a note for these case studies. When you put money into a life insurance policy, it's more than just buying a life insurance policy and being told, here's a $1 million death benefit, it costs $10,000 per year. No. If you're interested in a policy for cash value, you can choose how much you put into the policy, and you can also choose where that money goes. So money can go toward one of two areas. The premium, which primarily buys life insurance first and then builds cash value second, or toward what is called our PUA, which stands for Paid Up Additions Rider, which prioritizes cash value first and death benefit second. So keep those terms in mind because you're going to see those terms when we look at the case studies. So we're going to look at policies that were started before I had my life insurance license, some before I was even born, and then we'll look at policies that I set up. So let's start with some older ones. What we'll begin with is a policy that was started in 1975. That's a ways back, huh? When this individual started the policy, he was 35 years old. So what we'll look at is first a piece from the life insurance company. Here we go. So what we've got here, this is a piece from Guardian, one of the 4 major mutual companies. It speaks about their dividend history. But if we go down to the last page, we see some historical data here. Now this policy was started in 1975. What this sheet is showing us is every 5 years. So it's not every year. Now we did obtain the full sheet, so they have a PDF of this and they have it on Excel that shows the complete history of this policy. Let's take a look because we put it all right on Excel, year by year, not every 5 years. So, a lot going on here. I want to walk through a couple things. Firstly, he started at 35 years old. Why year 1 shows 1976 and 36 is because at the end of 1 full year, it is now 1976, and now he's 36 years old. The payment, just about $10K per year, $96.60. Total outlay, that's going to tally up all of your annual payments. Then we've got cash value, that's the money column. Death benefit, what's paid out when he dies. Then you have the dividend interest rate, which is going to be important because that will impact the performance of this policy. Quick side note, the dividend rate is never what your money is growing by. That's always a gross rate. Then you've got the annual rate of return, which when we looked at that bank-owned life insurance illustration, that'd be referred to as the annual yield. The internal rate of return is the average over time, the average growth rate. And then the annual cash value growth. This is the same as the annual rate of return, but it's just showing us growth in dollars. So firstly, when we look at the policy, what you'll notice here in yellow, between years 8 and 9, that's our break-even point. This is the first year the cash value is equal to or greater than our total payments. You'll also notice at this point in time, the IRR is no longer in the red. So if you're ever looking at a policy and you're looking at your column that reads internal rate of return, you'll see that it's negative until you finally have more money in cash value than what you paid into the policy. Does that make sense? Cool. So as we scroll down here, get a nice look at history. I have this through 2024, which is 84 years old at this point in time. Here we go. Almost 500,000 paid in, 2.4 million, almost $2.5 million in cash value. Here's the average growth rate, the IRR, 5.61%. The annual yield did fluctuate as the dividend rate fluctuated over time. But this is a very long horizon or long study period, almost 50 years. An average growth rate, a little bit less than 6%, with an actual policy from way back when. Again, with a life insurance policy, if you do everything right, how's the cash value treated? Safe place to put money, can access any time without penalties. It's also tax-free. So that is our Guardian policy. Let's check that box. Look at another policy, still before I was born, 1980. This is going to be a MassMutual policy with on a 50-year-old individual who funds about $14,000 per year. So we do have the PDF piece for this, but we're just going to look at the Excel workbook because it makes things much easier. Here we go. So the net out of pocket, $14,445 per year for 10 years, as this was a 10-pay policy, meaning the premium was only due for 10 years. The break-even point occurred between years 5 and 6. There's the dividend interest rate. Why I like showing these policies from the 70s and 80s is because that's when interest rates were very high, which means dividend rates were very high, which means the growth rates were also very high on life insurance policies. However, back then, someone might be saying, this is only earning 8.5%. I can get double-digit returns at my CD or money market, or my mortgage cost me 12 or 13%, which was true back then. Typically, we'll see interest rates just in the environment and interest rates on mortgages and what's available with my bank, a bit higher than the net yields on a whole life insurance policy at the time. So to illustrate, if I look at annual yields on life insurance policies and compare them with what I might earn with a bank with a high yield checking or savings right now, I might see a higher return on a high yield savings. But over a long horizon, we typically see a whole life insurance policy produce stronger results. So let's scroll down here. After the 10th year, payments stop. He pays nothing else in ever. This policy, we were able to continuously get data from through 2020. Can't get it anymore from MassMutual. Could be a number of reasons why. Could also be when we look at his age, so he's pushing 90 in 2020. He may have passed. That could be a reason why too. I'm not sure. But as we look at the returns, so bottom of the first one is the dividend column. Then we've got the annual yield. That's your yearly growth. And then we've got the IRR, which is the average. So there we go. Almost another, just about 6% when he's about 90 years old. And the returns peak much earlier than that with a whole life insurance policy, which you can see above, but that is an excellent topic for another time. So that's a policy from 1980. let's take a look at a policy from 2003. And this policy was actually started much earlier than 2003. No, I'm sorry, it was started in 2003, but the data we have is from 2020 onward. So this is a policy with New York Life that we did not issue in 2003. I was, I think, a freshman in high school, so I was very young. But someone did provide us all of their data for their New York Life policy. They weren't able to find the complete history of all of the annual statements, but we were able to collect the total amount they've paid in, and then we looked at in-force illustrations to see what things look like moving forward. So the policy was started in 2003, and the data here begins in 2020. Just to clarify that point, 17 years in. So he's 17 years in. He already funded 2020 when we put this together. Total cash value, $460,000. The dividend rate with New York Life in 2020 was 6% flat. He paid about $28K. The cash value grew to $511 and change, which means he got his $28K back and some on top of it. The annual yield represents the net growth rate he received in the policy. That's the percentage he received from the insurance company in total growth. What we could also do here, if we wanted to know, what did I actually get from the insurance company this year? What we would do is as follows. Make sure we've got currency. All right. Equals the 511 and change minus the 460 minus our payment. Always make sure you back out your payment. So the total growth that he received in 2021 was $22,000 and change. And then you can just drag that down to see what the illustrated growth is year over year. But here is a 17-year-old policy that is moving 4.5% and change per year, gets close to 5%. It's probably much closer now because New York Life's dividend interest rate has come up a bit. And with his policy, this was a policy that he did not start out max funding right away. So remember that side note we mentioned earlier, as far as those two terms, what to be aware of? We had the premium and then the PUA rider. So his premium was about $12,000. After he learned more about whole life insurance and specifically how to maximize the cash value, he did not want to start a new policy and go through the expenses. I should say he thought about that, but after discussing it with him, he had a policy that was 17 years old. If you put $1 into that policy, you're going to get your dollar back and a lot more. In his case, another $22,000 you get back. So where I'm going with this is if he has the option to add more money to his existing policy instead of starting a new one, we definitely want to look at that first. And this is something we look at with everyone we work with. If I have an initial call with someone and they say, hey, I've got a whole life insurance policy and I've had it set for several years, I'm going to ask several questions about that policy. Hey, when you set it up, do you know if you paid just the premium or did you add more into PUAs? What's the total amount you've paid in? Do you keep track of your annual statements? And a lot of times the answer is, I don't know, and that's okay. We help them get that information. But what I want to look at is how has it performed since you started? How has it performed compared to the original illustration? And then what do things look like moving forward if you keep doing exactly what the original plan was, if you add more money, or if we pull different levers to maximize the cash value, such as reducing the death benefit to increase the cash value performance. That's the kind of stuff we always like to look at first before we say, just start a new policy. No, because you got to go through the new expenses again. But that was a policy from 2003. We did not look to start a new policy because we can improve what he already had. Here's one from 2007. And this one is a story and a half, which I'm not going to get into right now. But he started his policy at 30 years old, he paid about $24,000 per year. It was a 100% premium policy, meaning nothing went toward the PUA rider. And here's what it looked like. So here we go. First year, he pays in $24K. What's his cash value? Goose egg. Second year, he pays $24K. What's his cash value? $21,500. These values, by the way, that you're seeing are from the annual statements and policy status reports. Now, I was a freshman in college in 2007. I did not have my life insurance license back then. So how we got this information is I connected with him years ago, and he transferred what's called the servicing agent rights over to us, to our agency, and then we were able to access this information to see what he paid in and then what his actual cash values were every year. So we referenced the annual statements, the status reports, see what the cash value was from the insurance company, because not everybody keeps track of all of those records, and then we take those values, put them on Excel. Same thing with the death benefit, and then we've got the dividend interest rate there. When is it highlighted in yellow? Between years 12 and 13. That's when he got his money back, and these are the actual results. So, would that be a good policy or a bad policy? What do you want that? Where you put $24K per year into a policy and just saw a loss until 14 years later. You started at 30, and then at 42 or 43 years old, 13 years later, you finally have a gain. No, that is a bad policy. Took way too long to generate any type of gain on the cash value. All right, let's look at some policies I've set up. So I've been in the business a little bit now. I got in April of 2011, but let's look at a policy that someone started in 2015, and this is for a really, really bright guy. His name is Greg. I've absolutely loved working with him over the years. He's got an IT and tech background. He also invests in real estate. So when he started his policy, he was 49 years old, and he started with funding $150,000 per year. He did not pay that every year for 10 consecutive years. He cooled off on the funding. But when we look at the policy, you'll see that the minimum premium is about $15,000, and then the rest goes into what is called his paid up additions rider. So let's take a look at this guy, if we can find it. All right, so what we're going to look at here is the Excel workbook. Okay. So I actually want to pull up the original illustration real quick first. Let's take a look at this guy. Never mind, not loading for another time. One more shot. All right, it worked. I love it when it works. So here was the original illustration. The screen size okay? That's better. So what we've got up top, annual outlay. So his plan was to fund $150,000 per year for 3 years, then cool off to $125,000, then cool off to $50,000 through the 10th year, and then stop altogether. This illustration is with MassMutual, and back in 2015, their dividend interest rate was 7.1%. That was high back then, especially compared to other life insurance companies. But why that's beneficial to know is because this cash value, guess what, is based on a 7.10% dividend interest rate. So, a couple things happened. The dividend rate didn't stay at 7.1%. It gradually came down, and he also paid different dollar amounts. So how we track the actual results of a policy And how you can tell that we didn't just make the numbers up here, because that's important, is what we look at is what is called an annual statement. So looking at this guy, here is his first annual statement. The first year, his cash value was $128,356. So if we go to the Excel workbook that we have, what we did is just take the values from the annual statement and export them on Excel. This way it makes it a lot easier to track year over year. So if we look at the next year, 2017, there we go. Total cash value was $273. Next year, you're going to see the pattern here. The total cash value reads $147. It's higher than that because there's an outstanding loan. So the true cash value is the basic policy value. That's the cash value built up from his base premium payments. And then you've got the fully paid additional insurance. That's cash value from his PUA rider. And those two together, it gives you your true cash value, or your total cash value that's compounding. So we can look at the last annual statement here. Let's go to 2024. This way you don't have to watch me go through every year. All right. So basic policy value, $113,103. Fully paid up additional insurance, $860,000 and change. All right, so back to the Excel workbook. There we go. As we look at this guy, here's our funding, $150 for how many years? 1, 2, 3, 4 years. What was the original plan? Do you recall? For 3 years, then dropped to $125. So this is not going to match the original illustration, and the reason why is because he's funded a different dollar amount. So he funded more aggressively through the 4th year, then he cooled off. And his plan now is to stop payments altogether. But as we look at the performance over time, performed quite nicely. Break-even point. This is what actually happened between years 3 and 4. To the right, you've got the dividend interest rate, which again is a gross rate. But then you've got the annual yield, which is the net growth rate, which is what he's attracted, what he's interested in knowing what the policy is growing by. So if we look at last year, 2024, where he did not pay anything, out of pocket was $0, cash value, just over $1 million. The dividend rate last year was 6.10%, but that does not represent the growth. Here's what it grew by, 5.38%. Remember, if you do everything right, we can access that tax-free. And he's been accessing it. He's been using the policy for loans, specifically for real estate deals. So this is why he's been attracted to it, that attractive tax-free growth rate that's also safe, not tied to the market at all, that he can leverage for other opportunities. So it's worked out quite nicely for him. Next, we've got someone who started a policy in 2017. He is in the healthcare industry, specifically in sales. He started when he was 45 years old, and the original plan was to fund it quite aggressively with $130,000 per year for 5 years and then stop altogether. So where his money is going, of the $130,000, you've got about 10% going toward the premium, and then 90% going toward our paid up additions rider. So let's start by looking at the original illustration here. We've got that on the left, but I want to pull it up on Excel, on the actual PDF file. Always have a backup. So here's his funding, $130K per year for 5 years. Here's his premium up here, 10% of the total payment. This was the original illustration from 2017. We can see that if we scroll down to the bottom. Prepared for, not going to know his name. If you're watching, you know your name. So he was 45 at the time of starting the policy, and he received the best health rating. And again, this was prepared on 2017. So to track the performance, we do the exact same thing that we did for the last individual, where we looked at the policy that was started in 2015. So we can see what he paid in, $130K per year, and then what his cash value was here. The nice thing about his situation is he has not leveraged the loan feature, at least not yet. And why that's nice, not because it's nice if you don't take loans, like it doesn't impact the performance. Why it's nice is when we track the performance, it makes the annual statement very, very clean. So that was 2018. Here's 2019. Cash value in 2018 was 111 and change. The following year, 229. There's 2020. 365. Let's just go to 2024. There we go. At about $750,000 and change. Okay. So, back to this guy. This will make it a bit easier. Here is the first attachment we looked at, the original illustration, where his plan was to fund $130 per year for 5 years and then stop. However, he hasn't done that. To the right, where you see actual performance, everything in that red box represents what has happened already. So, started in 2017, red box, takes him through age 54. Okay. How did it do this past year? Really the past 2 years. When we look at the annual yield column, 5.2%, 5.2%. In purple, it's his total gain, which represents the fact that he's paid in about $700,000. He has a little bit more than $850,000. That's where that total gain of $156 comes from. That's the total amount of dividends and interest that he's received from the insurance company over 9 years. What's really cool about that is that he ran a loss for the first 4 years. So it's really been picking up the pace, which makes up for that loss, which is the biggest thing I dislike about whole life insurance, by the way. For folks that are interested in the cash value, they always ask, why would I not do this? What are the drawbacks? It's the upfront hit. Like, that's it. How you alleviate that as much as possible is by reducing that premium down to about 10%. So of that $130, his premium was about $13,000. What doesn't show up in cash value is that for the most part. So by reducing that, you reduce the upfront hit, but we still take that hit. First year, the $13K didn't show up in cash value. Second year, same thing happened. That's why I'm negative years 1 and 2. But then, as time passed, got better and better. Now he's at a point in time where he can keep adding money, but if he stops, still grows at a very attractive rate. And he plans on using it for a real estate deal within the next couple months, actually. We've been looking at models. But this is an actual policy that was started in 2017, and I have loved the performance of this one. One, because it performed very close to the original illustration. It was a little bit less because the dividend rate came down. But even with that dividend decline, as we've looked at it in the following years, those returns have gotten stronger and stronger and are getting very close with the original projection in terms of the yearly growth rate. So overall, it's not under-delivering where I have to say to him, yeah, because the dividend went down, it's just not doing what it's supposed to, and then I'm hoping the dividend comes back up. Like, no, even though the dividends come down, the cash value is a little bit less, but it's growing at an attractive rate. I'm happy about it. All right, next, let's look at a smaller policy. So we're going to look at a policy that was started in 2018. This is for a child, age 11. This 11-year-old was rolling in it. I remember having the phone call with her. She's like, I want to put $12,500 per year into this policy. I'm like, do you even know how money works? She's like, yeah, I do. I know the exact return on this too. I'm kidding. Her dad set the policy up for her. So let's take a look at this guy. What we'll look at first is the original illustration. And this one we should be able to find. There it is. So started in 2018. Dad's plan was to fund this policy with $12,500 per year for 4 years, which gets a total of $50,000 into the policy. That was the plan. All right, so there's your out-of-pocket, $12,500 for 4 years. There's your premium, just about at 10%. This illustration was from, there we go, 2018. Female, 10 years old. Oopsie daisy. It's okay. So let's take a look at the Excel workbook. This will be a little bit easier to follow. So everything in the red box represents what has already happened. So the original plan was to put in what? $12,500 for 4 years. What did Dad actually do? Well, Dad's been funding more than that because he's been measuring the performance. He likes how it's growing. He also likes the benefits of cash value life insurance and plans on giving this to her someday when she's responsible. He wants to teach her how she can use it like he's been using his policy. But he's gotten her off to a really nice start where he's funded just about $75,000. And with the minimum premium, a little bit more than $100 per month, the plan is just to keep on feeding it. Like it doesn't hurt them at all. And why they like that minimum so low, a lot of parents like this when they set up policies for their kids, they want to start the policies off where they aggressively fund them. But then they've got a low premium. If it's $100 per month, he can easily say to his daughter, at 21 years old, I'm going to give you this policy. I'd like you to continue to fund that $100 per month because if you keep doing this, you'll get it back and a lot more. Like look at the annual growth rate here. This is based on the current dividend rate of 6.4%. But talk about a safe place to put money that just keeps on cooking as the years pass, and she's already well beyond the expenses. A lot of times we work with parents that want to start policies for their kids, and what we typically recommend is set the minimum so low, so if you say, hey son, daughter, I want you to be able to pay this policy in the future, that's the parent's intention, but if I ask the parent, hey, at 21 years old, you think you'd be able to fund 10 grand per year? Probably not. I wouldn't be able to. How about $100 per month? Yeah, probably. Okay. So if we set it up with $100 per month, that's all they're committed to if they want to keep on funding it. At the same time, if you want to stuff it with cash value early on, you can to give them a really nice head start. And if Dad says, well, it's still my policy, I own it, well, he can use it just like he can use his policy. But that's a nice case study because we can see what actually happened with the policy that was started in 2018 for a minor. All right, we're getting toward the end. Next, we've got a policy that was started in 2019. This was for a mortgage broker who funded a policy with 6 figures per year, so a large one, and this one was with Guardian. So let's take a look at this guy. Let me get everything up here. First, we'll look at the original illustration and then the annual statements. All right. So here's our illustration from 2019 when we look at this guy, where we can see that it's the bottom of the illustration, date February 12th, 2019. Okay. So when he started, he was 41 years old. Preferred Plus is the health rating he received. That's the top health rating with Guardian. You've got 3 different columns here. you've got guaranteed on your left. This represents the cash value growth based on the worst case scenario. So his plan was to fund $120K per year for 5 consecutive years. He did want to see the guaranteed cash value. 120 times 5 is what? $600,000. The break-even point, based on the guarantees, was policy year 5, which was very attractive because he had been doing research on whole life insurance, and he always saw that the cash value took a long time to break even based on the non-guaranteed side of the illustration. So he wanted to see the guarantees. That was very attractive. Now, this is an older product with a 4% guaranteed rate. The newer version of this same product has a 3% guaranteed rate, and this exact same design would break even really between years 6 and 7 with the lower guaranteed rate. But the non-guaranteed values, which is the middle column, is really what we want to look at. Because when I look at whole life insurance and see and ask, does it actually work? Well, what I'm hoping happens is everything based on the current dividend rate. So as we look at this illustration, just take note of year 5. $626,000. That's what the original illustration showed. Here's one annual statement. It shows the first 3 years. First year, that's what was illustrated, 105 and change. Second year, 228 and change. It's a little bit less than illustrated because the dividend rate came down 20 basis points. Same thing with year 3. Do you remember what the year 5 cash value was? 326 and change. Here's the actual results. So that's still year 3, year 4, year 5. The original illustration showed 626. The actual results by the 5th year is 624. The main reason why is because when he started, the dividend rate was 5.85%. That was in the first year. And then the second through 4th year, the dividend was 5.65%. Slightly lower dividend resulted in slightly lower cash value. Now in year 5, dividend came back up to 5.75. And then year 6, come on, there we go, 6.1%. No, I'm sorry, it's 5.9. And now it's 6.1. Let's look at the actual results rather than look at my scribble scrabble. So what we'll look at here, same thing we just saw. Original illustration on the left. There's the 626 in year 5. Also after the 5th year, we've got no more payments going in. There's the dividend rate. There's the annual yield. To the right, we've got what actually happened. Dividend rate. See that drop there? Years 2 through 4 came down to 5.65. Now it started to come back up. What else is different about this? Year 6, the actual shows 774. The illustrated shows 651. See the difference? He put another 120 into it. He liked the performance, he liked the tax benefits, he wanted to add some more money that he had in cash, so he added more than what was originally planned. So when we have a situation like this, where we're putting in more money than what the original plan was, what we can look at to track the performance would be the net growth rate. So the original illustration had a net growth rate in year 6 of 3.97%, whereas the actual results in year 6, 3.95%. 0.02%, like what's the difference? This year, as we look at it, original showed 3.98. actual 4.33% when we look at that. Why it's stronger now is because of that higher dividend rate. And then it picks up the pace even more when we lower the death benefit, which we can do after policy year 8 at the earliest without triggering a MEC, which is a taxable event. So that's a policy from 2019. And let's look at one more here. Here we've got a doc who started at age 45. He funded $200,000 per year. The plan was to do so for 5 years, which gets a total of $1 million into the life insurance policy. And let's look at our annual statements. And we'll look at the original illustration too, but I'm just going to prep these to make it a bit easier. Beautiful. So when we look at the Excel sheet, first year, he paid $200,000. First year cash value was $175 and change. That was year 1. Year 2, paid the same $200, cash value $358 and change. Year 3, what do we see? Cash value $562, and again, he paid the same $200. He's been consistent year in and year out. Year 4, $781 and change. His question was, break-even point. When I originally signed up, my break-even point was year 5, meaning I would have paid in $1 million, and I had more than $1 million on that illustration with that specific policy I wanted. Will that actually happen? Because at the end of the year 4, he's paid in $800,000, and he's got $781. So he needs to make up for that $19K over the next year. Let's look at the annual statement. Here we go. Paid in $200. Total out of pocket, $1 million. Cash value, just over $1 million. So let's take a look at the actual performance. Fun stuff, right? Depending on your appetite for whole life insurance, okay? So here's the actual results. You can see the breakdown. There's your premium. There's your PUA rider, $200K per year. There's your year 5 cash value. Now, his original plan was to stop payments after 5 years. However, it's looking like he's going to continue. He actually asked, hey, can I continue to fund $200K per year just because I like how this is growing and his cash flow is the same? And the answer is yes. What we put together in addition to this were illustrations that showed $200K per year for another 5 years, although he doesn't have to do that. This is an existing policy. The original plan and even the original illustration showed funding $200K per year for 5 years, but now we can pivot and fund up to $200K per year, year in and year out. So we built it with a lot of flexibility. This way, when life happens and he needs to pivot, he can. So, a lot of information there in terms of actual policies. Did it help provide some proof? So you can see policies that have lived the test of time and the actual results. I hope so, because that's why we track them, so we can see if they actually work. So, point number 2, this is going to tie into what we just covered here. How people are taken advantage of with whole life insurance. When does it not work versus when does it work? And we're going to go through this rather quickly because we're going to look at 2 policies that we just reviewed. Which one didn't work? Or which one would you want the least from those policies we looked at? I'll go back. For me, be that one. Because I had nothing in the first year and it took 12 to 13 years to get my money back. So with that policy, that was started in 2007. The dividend rate when he started his policy was 6.75%. We actually have the original illustration. We're able to get that for this policy, and then we cross-referenced that with the actual policy performance. So let's take a look at that. And this thing is going to look old and sloppy, because it is. It's from 2007, and how we got it from the insurance company is they scanned and emailed it. Look at that thing. It's nice, right? So up top, 30 years old, health rating, super preferred. Here's what I want to focus on here, because I know these numbers are not easy to look at or not easy to follow because it's all blurry. This was in 2007. That's $24K per year that we see under the annual or net premium. Original plan showed paying into it for 15 years. You've got your cash value and death benefit in the right, but this column, the annual dividend, no dividends for the first 2 years, which is common with older whole life insurance policies. But year 3, the dividend was $390. And year 10, almost $3,700. Year 14 was $8,267. Keep that in mind. I've got all these on Excel too. So here's the original illustration we just looked at. A little bit easier, right? In purple, you can see the dividend. $390 in year 3, and year 14, $8,267. That original illustration from 2007 was based on the dividend rate of 6.75%, and it assumed that it never changed. Okay, it did change. Here's what actually happened. This is so important to be aware of details here that often don't make sense to people, but the bottom line will speak to you. So, the dividend rate. By year 3, 2009, what happened to it? Came up, 7.3%. The dividend payment he got was what? $390. The exact same dollar amount as the original illustration. Shouldn't it be higher? Should be. How about 2010? The dividend rate was 7%. The dividend payment was $400. The original illustration, by the 4th year, 6.75%, and the dividend payment was $401. Does that make sense? No. But the cash value, it's also less. Let's go down to year 14. Year 14, the original illustration had a dividend of $82.67. The actual results had a dividend of $2,000. I know the dividend rate came down, but it should not be that much of an impact there. We don't see that with the policies we put in place, even with the same life insurance company. So what's going on here? Like, why is it underperforming so much? And the actual results in year 14 were $355, whereas the illustration showed $392. It's a lot less. What do we have at the bottom right for the dividend? Who cares? He felt like that. He canceled his policy. And again, this was a policy he got. I was in college at the time, but he transferred servicing rights over. We tried to fix it and such, make some changes. After so long, he said, forget it. Like, this is just not performing how I was told. I don't like it. So he got out of it. But why did it underperform so much? Because this right here is a big, big problem in the life insurance industry, overpromising, under-delivering. Like, it is the problem when people get policies for the cash value. This one had to do with the policy design. 100% of his payment went toward the base premium. When I see dividends under-deliver in actual performance, it's always a result of a high base premium. Like, that's it every single time. I always hear from my peers, if you go with a policy with a high base premium, you should have more cash value long term because the base premium drives the dividends long term, especially if dividend rates go up. Yeah, I see that on an illustration, but I've never seen that actually happen. What I always see happen is a bunch of games played where the actual results under-deliver compared to what was shown on that illustration, and then the client ends up with less money. Therefore, I'm not comfortable setting the base premium higher because then the client loses out, but I don't. Where we're compensated as agents is on the base premium. Anyway, when does it work? Well, we looked at policies that worked. If we look at the policy started in 2015, that started with a dividend rate of 7.10%, gradually came down over time. The original illustration, this was the one where he paid $150 per year. Let me pull that one quick. So here was that original illustration. There's your premium breakdown on the bottom. So of the $150 he's paying in, there's the premium, just about 10%. There's the PUA rider, just about 90%, which gave him more cash value up front, about 133 and change, and just accelerated the growth as time passed. In fact, let's look at this on Excel. Here's the good policy. That's better. So now we see a breakdown of where his money is going. In red is his premium, purple, PUA payment, blue is what he cared about. That was his net out of pocket, but we wanted to get the most out of his net out of pocket as possible, which there's his cash value based on the annual statement here. The original illustration was different. Break-even point. We already looked at this policy before, so I won't go through all the details. But when we've seen policies actually deliver strong returns on cash value is when they've been designed with minimum premiums, which is just really knowing how low we can set the premium with each specific life insurance company and then pushing it as low as possible. It's what I like to refer to as the rules of the game. So the policy that worked was the one that had a minimum premium. So the takeaway here, before ever starting a whole life insurance policy, especially if cash value is your goal, what I would do is review the different options. I would ask questions, then I would ask more questions, and I would pull in friends and trusted advisors you have that can help you ask questions that you might not be thinking of. And then third, after you start a policy, make sure that you have your agent review the policy performance year over year. And one of the best things you can do in order to see the numbers for what they are is look at the original illustration and compare that with the actual results. Where that can be different is if you pay different amounts, that's going to throw things off. But if you're consistent with your funding, that's going to really paint the picture in the right way so you can compare the original with the actual and then see how much the dividend rate adjustment actually impacts the cash value. All right, last point for this evening, how to copy what works. So there's two things here. You've got the insurance company that you choose, and then the policy design or setup. So with the policy design, really what we want to do here is set it up where we reduce expenses, reduce commissions, and increase cash value. First, company selection. All of the policies we went through were with the major mutual companies. Mass Mutual, Guardian, New York Life, and Northwestern Mutual. When we look at those four companies, I've seen consistent proof of performance where we can get policies from them where they say, here's how much was paid into the policy, here's the cash value, and here's what actually happened. And then we can crunch the return if they don't provide it for us. But it's proof, and they can provide it, which is very valuable to me. I can't always get that from other companies, not yet at least. Again, I want to see the proof before I recommend someone put their money into a product. But then policy design, how to reduce expenses, shrink that base premium as low as the company will allow, how to reduce commissions, which results in more cash value, shrink that base premium as low as the company will allow, how to increase cash value. After you've shrunk the premium, beef up that paid up additions rider. So what I would not do is ask, how much more can I pay into my PUA rider than what I'm already paying into the premium? I wouldn't do that. What I would do, if I'm getting a policy, let's pretend that I said I want to put $10,000 per year into the policy. I would say, of that $10,000, what is the lowest the premium can be and the most the PUA payment can be? We've got three options. A high cost option, meaning of that 10K, all 10,000 goes toward the premium. Nothing toward PUAs. First year cash value is going to be a goose egg. Second, moderate cost. I've got a $10,000 total payment, $3,500 premium, and then a $6,500, not $5,000. I didn't learn math in school. There we go. $6,500 PUA payment, and the first year cash value is going to be about $6,500. I'll see the PUA payment for the most part show up in cash value. But that's a moderate cost policy. And then second, minimum cost. If I wanted to pay the exact same $10,000, $1,000 premium, $9,000 PUA payment, first year cash value is $9,000, and I also have an earlier break-even point. The cash value is growing at a faster pace, and I'm happier with my policy because I see my money there. The last thing that I like about that setup is if life happens, what do you think I'm obligated to? The premium piece. So with a minimum premium policy, I'm only obligated to $1,000. Whereas with a high cost policy, $10,000 base premium, that's what I'm obligated to. So if I shrink the premium, I shrink my minimum commitment, and now I'm not stressed about getting this big bill every year. Make sense? All right, cool. So we covered a lot. We're gonna have our Q&A shortly, but just a quick note here. If you'd like to connect with us, I'd love to talk with you about all things cash value life insurance. What we do a little bit on our company, we do primarily focus on whole life insurance and also other strategies and products. We do more than this. You can see some case studies and some of our content on YouTube. But focusing on whole life insurance, what we do is first help everyone set their policy up with as much cash value as possible, and then help them use their policy. So it's not a case where we just sell a policy and say, see you later. No. Our focus is really on the customer service side of things. Everyone we work with, we reach out to them every 6 months, really with an offer for a review call, have a review meeting, track the policy performance, look at loan strategies. If the loan interest rate has adjusted, we want to make sure that you're always kept up to speed on that, all of that fun stuff. We do work a lot with real estate investors, like the individual we looked at earlier toward the beginning of the webinar, specifically how he plans on using his policy. That's the kind of stuff we want to help forecast so we can see the true cost to borrow. Business owners will often do the same, using the cash value as a personal line of credit. We do service banks and corporations, and then we have recently spent a lot of time with retirement strategies as well, which is a lot of fun. We've got our contact information up there. And with all of that said, thank you again so very much for taking more than an hour to hear me talk about life insurance. I hope I didn't bore you too much. Let's take a quick 5-minute break, and then we'll come back for some questions, and we'll have some fun talking about life insurance. Thank you again, everyone who is not staying on. I sincerely appreciate your time. Until next time, we'll talk to you soon. All right, let's hit a couple questions. Thank you, folks, for your questions. So the first one we've got, can we pick who we work with from IBC Global? Can I simply pick Steve in lieu of who was assigned to me? So good question. I will always have a phone call with you. So typically we always like to assign one of our associates with those we work with. We've got 5 really good teammates here that I've been working with for several years. I do still have conversations with clients. So if we ever do have an initial meeting, it's rare that I'll meet with you one-on-one. I always like to include another agent with me. This way, from a response time standpoint, one of us is going to get back to you faster. So to answer your question, I won't be able to work with you solely. However, I can definitely meet with you at least once to help with the initial design of the policy. And then a lot of people we work with, a lot of times will always email their agent. They'll CC me, the agent will respond, CC me, and then vice versa. We'll always work as a team. So you'll get more than just one of us too. So I'm always involved, but I'm unable to work with folks one-on-one just as it's difficult, really because I'm slower to get back than I'd like. I hope that answers your question. Next question we've got from Lorenzo. So Steve, you have only mentioned the 1090 policy setup, but not the other that were at 4060 or 3070. Wondering why not. So in noting this point of clarification. So good question. The policies that I've set up for the most part have been 1090 designs, which is just pushing the premium as low as possible. The main reason why is because when we study the actual performance of policies, what I've seen is that a minimum premium design results in the most cash value for the policyholder, not just on an illustrated basis, but also based on actual results. So where I've seen policies under-deliver the most is when the base premium is higher. The worst I've seen is a 100% base premium design. But even if it's a 30/70 or 40/60, that's where I've seen them still under-deliver. I have set those up in the past when I did not have as much knowledge, but working at an executive benefits planning firm where we had to study the actual performance of whole life insurance policies for corporations that were looking to purchase large whole life insurance policies. We'd always want to make sure that we maximize the cash value. So why we primarily look at the 1090 is because with the major mutual companies, the lowest you can typically set the base premium is about 10% of the minimum premium. It's not a clean 10% across the board. All companies have different rules. There's exceptions too. If you look at Guardian, they've got two exceptions. One, all of the products, you can actually go up to 50 times the base premium in PUAs in the first year. And then if you look at their 10-pay policy, the most that we can illustrate as an agent is not 10x the base premium in PUAs, but only 5x the base premium in PUAs. So the 1090 is not a hard number to say this is going to be it every single time. Every situation is unique, but what is fairly consistent on our side is we are always going to strive to minimize the premium simply because we've seen that deliver the best results for policyholders, and it has not resulted in the overpromise and underdeliver, which I want no part of. Next question, do you sell Penn Mutual policies? So yes, we can, we're licensed with them. I do like them from a business philosophy standpoint. I've had a number of conversations with some of their executives. We don't use Penn that much. The main reason why, just to this point, is I have not seen proof of performance, specifically a consistent track record of real cash values that have delivered at least a 4% internal rate of return or greater. Their illustrations always kick butt, but they've kicked butt for a long time. Where on paper, they tend to project the best looking numbers. But then when I look at historical policies, we didn't go through them this evening, but we do have one policy from the 1990s. The IRR was less than 3%. And it's someone who had just consistently funded their policy year in and year out. So again, I'm not saying that they haven't done it, but in working with them, we still have not been able to obtain one, and that's our big thing. So to answer your question, we can sell them. We've sold Penn Mutual policies, particularly with people that have had term policies. They worked with us, they made us the servicing agent, and we converted that term to whole life. We still maximized it. We track the policy performance, but we don't recommend them to the same degree as the major mutuals for the simple reason of the proof of performance, where we haven't seen it yet. Next question. Which insurance company is more favorable to the 1090 setup versus others? So, good question. When we look at the major mutuals, you can typically attain a 1090 design with all of them, or at least very, very close to it. Again, it does depend on the insurance company and product, but if it's not a 1090 with a true 10% minimum premium, I would still ask how low can that base premium be? based on the insurance company's rules. What can you illustrate, agent? What do their memos show? This way I know the information. How low can you go? Whether it's a 10% minimum, a 25% minimum, all companies have different rules. Like if you look at Mass and Guardian, typically I can set that base premium as low as about 10%. If I look at an AUL, typically I can set the minimum premium about as low as 25%. If I look at a company like Lafayette Life, they don't have a rule where it's a multiple. What they allow is I can pay up to $500,000 per year into PUAs. However, they've got a limit with how big of a term rider I can attach. So typically with Lafayette Life policies, the lowest we've been able to drive their premium with products like their Contender whole life insurance policy is, depending on an individual's age, somewhere between 3.5% and 5% of the total premium, the total payment. So you can really drive a low base premium if I'm looking at an illustration with a Lafayette Life, for example. So it does depend on the company in that respect. Hope that makes sense. Really, really good question. Next question we have here. Can you do a sample illustration for Penn Mutual with the new accumulator whole life insurance policy in one of your videos? Yes, we're actually working on a video for that right now as we've did a case study for someone. There's a client looking to put in $100K per year for 3 years, and we looked at a comparison of Mass Mutual's 10-pay, Guardian's 10-pay, Guardian's L95, and then Penn Mutual's product, and I'll share the results in the video when that comes. What's surprising is I won't say it. You have to wait for the video. All right, next question we've got here. So thank you for the detailed webinar. Thank you so much for watching. I have a Guardian policy with a 2-year PUA, so 2 years of PUA payments with 8 more yearly premium payments. In years 3 through 10, can I make additional payments without triggering a modified endowment contract? So good question. So it depends on a couple things, specifically how your policy was set up. So if your policy was set up where you have a $1,000 base premium and a $10,000 MEC limit, you can pay your 1K base premium and up to $10,000 per year. Now, if we set it up where your MEC limit is a little bit overinflated, Guardian may allow you to add the extra funds into your PUA rider. You can always check if it'll MEC just by going on your online portal, go to make a PUA payment, and just type in $1 million in the box, right? An excessively high number that you know will MEC. Don't hit pay. Once you punch that number in, what you'll see is a red warning message pop up on the top that'll state, warning, if you pay this much money or more than this stated dollar amount, your policy will become a modified endowment contract. Are you sure you want to do this? More or less is what it says. So it'll always tell you the maximum dollar amount that you could add to your PUA rider for any given year. You can always reach out to us and ask too. We can get that information in about 30 seconds. Sometimes 60 seconds if the software loads slow. But good question. All right, let's continue on. Can I add death benefit to an existing policy? Really good question. So if you have a whole life insurance policy, you typically can increase the death benefit. This is referred to as a face amount increase, could be a whole life death benefit increase, or you can add a term insurance rider, especially if you don't have one attached. If you do have a term rider attached, you might not be able to increase that existing term. With that said though, it does require medical underwriting, and then also typically does not impact the MEC limit. Meaning, if we increase the death benefit on an existing policy that's more than 3 or 4 months old, I'll have more death benefit, but not always more MEC limit. So it doesn't always make sense in that respect. With that said, depending on how old your policy is and what life insurance company you got it with, you'll often see programs available where for a period of 4 to 5 years after I start a policy, I can get an additional policy with limited to no medical underwriting. Now my age and health will play a factor there, but a lot of times we work with clients, especially those that are under the ages of 60, especially under the age of 50, where we can get them a new policy based on the underwriting they went through from 2 or 3 years ago. But good question. Let's look at the next question. Do the big four, being the major mutual companies, take on aviation-related folks, pilots and mechanics? Yes, really, really good question. If you're a pilot for a commercial airline, we've worked with a lot of pilots. Typically, that's a non-issue. We don't even need an aviation exclusion rider there, which is nice. For folks that may be in the Air Force, or if someone is in a high-risk occupation, to put it that way, and it's because they're flying, I won't go into any more detail, but they're not just a commercial airline pilot, that's where they may be declined, or an exclusion might need to be added to the policy. So it does depend on your specific job. Like if you're just a commercial pilot or work for a commercial airline, that's typically a non-issue. But if it's something different, that's where we would definitely have a conversation about it. We do have a guide that can provide some more information on what occupations are a non-issue and what occupations could result in your policy not being approved or perhaps rated, maybe even declined. The answer to your question is yes, but there are some sub-items that I just want to go over because it could be a no, depending on what type of aviation you're referring to. Good question. Next, we've got, do you prefer the Guardian L95 dividend or the L95 STP for long-term performance? So good question. So with Guardian, you've got their PUA rider. So PUA version 1 is just called PUA rider, and then PUA version 2 is called PUA STP. So PUA STP. Chelsea, you know what that stands for? Oh, come on, I joke about this all the time. So, we've been working with Guardian for a long time. My name's Steve, right? Most of you probably know that. My wife's name is Tara. And my last name is Parisi. So what Guardian was so nice to do, their PUA STP, actually stands for Steve and Tara Parisi. Can you believe that? Because we brought them so much business. I'm being sarcastic. That is not what it means at all. You can tell I'm a weirdo, right? Making jokes about a PUA rider. So their STP represents their 5% PUA fee. And if it just says PUA, that represents their 10% PUA fee. What the STP represents is short-term performance. So to answer your question, personally, I prefer the STP right now. And the reason why is because when I look at Guardian policies, since I've been in the business and even before then, they've operated with that 5% PUA fee. And when we track the actual performance of policies, I've seen them deliver with that. The 10% PUA fee was rolled out with Guardian at the end of 2021, early 2022, when there's a big industry change where guaranteed rates were adjusted and such. So I haven't seen it proven out over a long period of time. Not to say that won't happen, because Guardian always performs well when I track the actual results with the illustrations, but I like to see that proof, even if it's a major mutual company. So I do like that 5% PUA fee because it's proven. I'll see stronger guaranteed cash values. And also, as a business owner, when I put money in, I like seeing more of it there as it's an opportunity cost. With that said, we do work with a lot of people that gravitate toward the 10% PUA fee. My mindset is show both options, go over the pros and cons of both, and let the individual select the one they like the most. If they're torn, you can always split it. Whether it's 50-50 or 70-30, like you can get two policies and just split it between them. Like that's not difficult to do at all. So we like to show the different options there and help one select the option that they're most comfortable with. What I never want to do is say, I like this one, therefore you should go with that one. No, that would not be right of me. At least I do not think so. Next question from Greg. Have you ever worked with a client to design a large policy with a premium finance component? So yes, and we've got some models too that we built over the years that are designed for premium financing. So to answer your question, I've designed policies and models. We don't do much of that. Really, we don't do any at our company. And the big reason why is premium financing has a place. However, most folks we work with are interested in whole life insurance for the cash value because they want to be able to use the cash value for opportunities, whether it be real estate, business, whatever. So with premium financing, my cash value, I typically don't have access to it. There's a collateral assignment because the premium is being paid by a lender, and then I've got to post some collateral initially unless it's 100% cash value up front. So premium financing is typically used for business owners, estate planning cases. Again, it has a place, but we don't do it too much personally. We do have models that we build to show the actual spreads to see if it's in the client's best interest, but we don't do it a whole lot just because it's not really our market. But thank you for the question. It definitely has a place depending on what we're looking for. Another question here. If you were starting your first policy as a young person, what company and product would you select? Really good question. I would start with one of the 4 major mutual companies, and then I would go over the PUA flexibility. So when I was young, I was broke. So if someone told me, hey, with this policy, if you put in 10 grand per year, it's really going to build over time. When I'm young, right, before the age of 25, I'm like, 10 grand per year, I can't do that. And even if I could do it 1 year, I'd be stressed out of my mind. So what I would really want is a company that has a lot of PUA flexibility. This way, the policy never feels like a burden. So for example, if I've got my whole life policy, and let's say the target amount is $10,000 per year, meaning if things go well, I can put up to $10,000 per year. When I set that policy up, I can go toward the premium or toward the PUA rider. What I would do, set it up for my premium, if possible, the premium plus the term rider, comes out to $1,000 per year. It might be a net of $1,200 when I look at it, so $100 per month, but an amount that does not feel like a burden. So, no stress. Reduce the chances of me not being able to pay and that policy lapsing down the road. Like that is what I would focus on for a young individual. And I would ask these questions too. So, youngster, you want the option to pay in $10,000 per year. Okay. Think you'll be able to fund that every year? How about the first couple years? I don't know, it might be a bit of a stretch. Yeah, there'd be no way I'd be able to do that at your age. I can share what a lot of people do. So if you want the ability to pay up to $10,000 per year, we can set it up where your minimum is about $1,000 per year. You could even pay that monthly, a little bit less than $100 per month. Do you think you could hit that number without any stress? Yes. Okay, great. Now, if you pay just the minimum, it's not really going to grow. Right? It's going to be a pretty unattractive policy. So adding more money is what will really help it grow over time. So you'll have the option now to add another $9,000 per year, but you're not committed to doing so. So Joe, to get into your question as far as what company I would select, they all have different rules. If I look at a guardian of the major mutuals, I can set it up where literally I'm billed just for the premium. So the premium is what I get a bill for. That can be paid yearly or monthly. And then PUAs, I can add at leisure by logging onto my online portal and just transferring money to my PUA payment. So it's very flexible in that respect. So this alleviates a lot of stress. Mass Mutual, on the other hand, I can set up with the same minimum premium. The thing is with them, the PUA and premium typically need to be paid at the same time They do have a rider that offers a little bit of flexibility, but it's confusing to most people, so we don't use it that much. But with the premium and PUA, yes, they need to be paid at the same time, but I can adjust them one time per year on my premium anniversary date. So if the first year, say I pay a 1K premium and a 9K PUA, and I fund 10 grand, but then the next year things are slow, what I can do is scale the PUA down, where maybe my total payment is now $3,000. The 1K premium stays the same, that can't be adjusted, but I scale my PUA down to $2,000. So I can adjust it one time per year without underwriting. The same is true when I adjust it back up. But I would go through the flexibility details, because for someone younger, where their cash flow is probably more limited, but maybe they've got good saving habits or they're trying to instill discipline, I don't want to put them in a position where it's going to feel like a burden or they're not going to be able to fund it, because that's where the policy is going to lapse or something like that. So I'd go through the flexibility rules first and foremost, but I would stick with the major mutuals because that's where I've seen the quality. Good question. Next, from Andy, policies for minors. Would you still recommend 1090 designs if you want to max fund the policy for longer periods until age 65 without reaching the MEC? It's a really good question, and I thought about including a case study in today's webinar that goes over that. So the answer to your question is yes. For the policy that was started in 2020, remember the doctor that funded $200K per year for 5 years, $1 million? So he started policies on his 2 boys where he funds $50,000 per year. The minimum premium is $5,000. The rest is into PUAs. And his plan is just to keep on feeding that as long as possible. Like, they're designed to be able to fund beyond age 65 without triggering a MEC. And it's a 1090 design, so they've got cash value up front and long term. So the answer to your question there is yes. Now, it depends on the company selection too. Like, MassMutual's products really accommodate that type of design. But if somebody likes Guardian's flexibility, then we've got to talk about that, because Guardian's design doesn't allow a 1090 and the option to fund with a 1090 design for 30 years. Like, the term rider is not going to last that long. So the answer to your question is yes, I would still do that for minors, but at the same time, there's just a couple things I want to make sure I provide enough guidance on. This way we don't run into a situation where we say, oh, I didn't know that. Never fun, which has happened. Like, I've run into that with folks before, and I don't like it. All right. And last question, have you seen Guardian's indexed rider keep up as projected? During some study periods, yes. During others, no. Because it is indexed, it depends on the S&P 500 index. It also depends on the month of my policy anniversary date, and then it's an annual point-to-point. So if I started a policy in September, then that index is based on typically September to September every year. So sometimes we've seen it perform. We've got a couple examples of where it has really outperformed the dividend, which is nice. But then other examples, like we've seen the index produce a negative return. The client hasn't lost any money, which is nice, but it didn't perform as they were expecting it to. So sometimes I see it keep up with projected, sometimes better, but not all the time. All right, good questions. Thank you, everyone, so very much. If you have any other questions at all, feel free to reach out to us directly. You can also schedule some time to connect in the link in the description. And as always, I hope this helps. Thank you again.